Hello, all. Welcome back to Tech Tune Up. I'm your host, Paul Meeks. I'm supported by Harvest Portfolio Management over my shoulder. And of course, our friends at Benzinga. Today is May 14, 2024. Lots of news impacting the tech sector. So let's get right after it. So, first of all, I'd like to share that breaking news: the CEO of Amazon Web Services, a fellow by the name of Adam Selipsky, has stepped down, and we don't know why yet, but it's very odd to me because Amazon Web Services, which he led, is the most important group within Amazon.com, which of course is one of America's most important companies. And if this fellow thought he would be CEO someday, which he probably did, this is the way to go through it. You don't become the CEO of that company if you're not Jeff Bezos coming out of retirement, if you don't come through Amazon Web Services. And this company just announced its quarter a couple weeks ago, and the revenue growth for Amazon Web Services was surprisingly good and better than Wall Street expectations. So it doesn't seem to me, at least on the outset, for this to be a performance issue. Very interesting, very intriguing, and we'll see what happens over time. Of course, I'll report back. Next in the news, OpenAI. OpenAI, of course, is the company that created ChatGPT, introduced it in November of 22. It is 49% owned by Microsoft. And they just announced their next iteration of ChatGPT 4.0. And the O is a lowercase o, stands for Omni. So what they're trying to achieve here is to enable users using text, audio, or images to input into the chatbot, and also to receive feedback on the other side. This could be very interesting, and this could actually take a crack at Google's search model. So stay in tuned. Microsoft announced that it's spending, it doesn't seem to be able to get enough of this, more money on AI infrastructure. It is going to spend 4 billion euros in France. You may recall that I reported over the last couple of weeks, they're spending in Indonesia, they're spending in Malaysia, and they're doing everything they can to avoid China. Next, I think this is interesting. Foxconn, which is the world's largest contract manufacturer, which means that they put together other people's products. Locally in Taiwan, it's called Honhai Precision. They announced a really strong quarter, but this is interesting. They are best known over time for making the iPhones for Apple. They announced a great quarter, all based on assembling AI-centric servers. Nothing to do with the iPhone, which has actually been poor, and we saw that with a 9% decrease in revenues year over year in Apple's most recent quarter. I think this is the news of the day. The meme stocks are back. We've already reported it here on Benzinga. Here comes our old friend who's been in hibernation since 2021, a fellow by the name of Keith Gill, aka Roaring Kitty. I will tell you this: the stocks that have exploded upward in this rally, which is mostly due to short covering, stocks like GameStop, AMC, and even your buddy Donald Trump's company, DJT. I don't know if they're going to stick. They're probably good shorts at some point. In the meantime, they've squeezed the shorts. But I will tell you this: when you go back to 2021, excuse me, with the meme stock rally, it was pretty cool. It was the little guy, Roaring Kitty, going against the mega hedge fund managers and winning. It was an embarrassment to Wall Street when he testified in Congress. But I will tell you, even though a really cool and funny movie came out of that, at the end of the day, maybe the short sellers were wrong with their timing, but these stocks were obliterated. And that's why we probably haven't heard from Roaring Kitty for several years. Folks, DJT, GME, AMC, I don't know when the stock stopped rising on fluff, but they are rising only on fluff, and they are definitely short candidates. And if you don't get into short selling stocks, maybe you just avoid them. Don't get caught up in this hype. Despite how great of a feel good story it is, it's going to end badly. All right, next. I'm calling a spade a spade. I had Duolingo, ticker symbol DUOL, which is the foreign language app, on my buy list. It has been a great stock. They announced a really good quarter last quarter. And afterwards, Wall Street analysts raised their numbers for revenue and earnings per share. However, the stock has plunged since then just based on expectations were too high. As I said last week, I was waiting for the stock to successfully test its 200-day moving average price. It did not. The stock is broken through on heavy volume. And so I don't stick around with losers. You have to have a sell discipline that is every bit as strong as your buy discipline. And when Duolingo did not hold its 200-day average, I'm out. It's off the Meeks buy list. Next story, Temu. You may remember Temu's Super Bowl commercials. This is the Chinese e-tailer that's trying to take a chunk out of Amazon. They put a lot of resources into the U.S. market, and this is kind of interesting that after a couple of months, it looks now like they're reining in their U.S. exposure. Very interesting because they seem to be all in recently. Next, Intel, a semiconductor stock that I poo-pooed for a long time. This has not been an American leader since the 1990s, and don't think that it's going to come back to its previous position. But they are going to spend $11 billion to build a fab. That's what semiconductor companies call their manufacturing facilities in Ireland. And this is the interesting part. Of the 11 billion tag, some of the bill is going to be put by a private equity company called Apollo. It's very interesting for me to see that these semiconductor companies are ramping up their spending, but they're using other people's money. And I haven't seen in all the years I've covered this sector such a push by private equity to support companies in this kind of spending. Not companies that are private, they're hoping to go public, but public companies, and particularly a big dog like Intel. Very, very interesting. Uber is looking to essentially have a food delivery monopoly in Taiwan. They are offering to buy Delivery Hero's Food Panda business. And between Uber and Food Panda in that country, they have 100% of the enchilada. So this will be interesting. We'll see if there's any pushback on a regulatory basis. Next, you have a once popular public company going private. The story of Squarespace, ticker SQSP. It's going to go private at $44 a share. The problem was it went public 3 years ago at 48. So you've lost a little bit of money. And of course, over that 3-year span, the S&P 500 or any index you could have passively invested in went straight up. So this has been a dog with fleas, probably good riddance. This is a company that helps you design your website and do some other digital services. Of course, they probably found that that can easily be done remotely from somebody in India or in the Eastern Bloc. So goodbye to Squarespace. More information on high bandwidth memory since the last I appeared. High bandwidth memory is absolutely critical for AI infrastructure build. There's only 3 people that really do it. Micron here in the States, and then 2 South Korean companies, SK Hynix and Samsung. They have bookings, sold out capacity, all 3 of them in this triopoly that extends not through just 24, but all the way through 25. I've said it several times. I'm sticking to my guns. Micron, ticker MU, is my favorite U.S. technology pick, even after it's done great for us. I think this is kind of interesting. I don't usually cover the consumer space, but I'm always looking for tells, just like you're looking for tells here on Tech Tune Up. So Home Depot, everybody's been to Home Depot. There's 2,300 stores around North America. They issued their results this morning. Their current quarter was okay, but their guidance was super cautious. And this is another indication of a theme that I introduced a couple of shows ago about a slowdown in consumer spending. No better indicator than Home Depot. And of course, this is a good thing and a bad thing. The bad thing is it impacts negatively companies like Home Depot and some of our tech companies. The good thing is it shows that the economy is finally slowing. And when the economy slows, inflation will go down. And when that happens, our central bank, the Federal Reserve Board, will lower interest rates. And that will be a huge boon and usher in another bull market for our tech stocks. Next up, Alibaba. Alibaba announced their results. Years ago, I liked Alibaba as much or more than Amazon. It was dominating a much bigger market in China, doing the same thing essentially. But times have gotten really tough for them. They just announced their quarter today. Their earnings were down 86% from a year ago. I've told you before, with the Communist Party's stranglehold on these Chinese tech companies, most of them are uninvestable. No matter how good they look, the government could take them to zero overnight, and almost did that with a near-death experience for Alibaba a couple of years ago. The only Chinese tech company that I'm somewhat interested in is Baidu. And it's because Baidu has forged some relationships with the like of OpenAI, with the like of Apple, to essentially have AI on board on the iPhone. And so they might have some game. That would be the only way I would play Chinese tech. And I've been doing this a long time, and I have been burned. So I'd like to do a deeper dive on a company today. If you're into this sort of thing, I do a show called Wall Street Beats, where every time I appear, several times a week, I do a deep dive on an actionable idea, just one per program. And so do some of the other panelists. But I'm going to take a look today at ARM, A-R-M. And if you can't short the stock, I would beg you to avoid it. Or if you've played up its recent run, I would sell into strength. This is a British semiconductor company. Only 10% of its shares float. The other 90% are controlled by the Japanese conglomerate SoftBank. And this company was public, then it went private, and then it just went public about a year ago. I took a close look at their financial statements at the Citadel here in Charleston, South Carolina. I teach financial statement analysis, so I know how to uncover accounting fraud. So what I did is I took a look and I saw a huge disparity between their financial results, particularly the income statement, things like revenue, expenses, and profits that were calculated based on Securities and Exchange Commission mandated generally accepted accounting principles, and non-GAAP coulda, woulda, shoulda earnings. We call that the fluff. And usually tech companies have a disparity between the two because tech companies on their non-GAAP results do not include stock-based compensation as part of their expenses. So most tech companies have a little bit of a delta between non-GAAP and GAAP. The problem with, and I think there's accounting fraud here, ARM has a huge gap. They just announced their fiscal 24, ended at the end of March, and they earned $1.27 based on non-GAAP and only 20-something cents based on GAAP. That is too big of a spread. That is a huge red flag. Be very careful. I think what this company did is they kitchen sinked their expenses right before they went public a year ago to make the future quarters, which we're now 3 quarters in as a publicly traded company, look so much better. But pretty sleazy. The other thing about ARM, which I think is interesting, is they love to talk how they're going to have a new AI chip. So this really gets stuck in my craw. Not just ARM, but all kinds of companies the last couple of weeks are saying that they're going to snap their fingers and build their own ARM chip, that they don't need NVIDIA. I will tell you, This is super sophisticated, complex engineering. You can't just do that. So I'm seeing AI, particularly AI chips, in a lot of PowerPoint presentations, in a lot of press releases, in a lot of commentary on these quarterly calls by CEOs and CFOs. They are BS. ARM says they're going to have a prototype device later this year, and then they're going to start to ship it in 2025. Believe it when I see it. But of course, with the hyperbole, that drove the stock up. You guys, you want to invest in AI chips. Even though the stock has already done very well for us, it's up multifold. Just buy more NVIDIA. And then the last thing I would say about ARM's valuation, here's a company that, if they're lucky, they'll continue to grow at about 20%, which is, great for an average company, not necessarily so great for what is perceived to be the fastest growth tech company. And they won't have any opportunity for margin expansion because their margins are already pretty high. They may even go down over time. And right now, the stock is trading at 80 times next year's earnings and about 31 times next year's revenue. The greatest software companies, which is a license to steal because they have almost 100% margins, trade at 6 to 8 times sales. This company trades at over 30 times sales. So please don't believe the AI hype from ARM and stay away from it. If you have a chance, even though it's tough to do because the float is so small, maybe it's even a short candidate at some point. I'm looking for that opportunity. So next, let's take a look at my picks. You know my cover scheme. Yellow is we're waiting at the light, we're holding, we're waiting for some more dough. Green means fresh money buy, and red means escape as quickly as possible. So I'm a little bit incrementally cautious on my favorite cybersecurity software company, CrowdStrike. They have their next quarterly report due on June 4th. So I only have to wait a couple more weeks for fresh info. But some of their competitors, now remember, I've always told you that this is the best in class in the industry. But some of their competitors have had some squirrely results. Makes me worry that if there is a industry problem, it's going to impact CrowdStrike, because CrowdStrike is the best of the bunch, but it's still in the bunch. I continue, as I've told you many times, I love the AI infrastructure build. I love high bandwidth memory. I love the triopoly position between just one U.S. company and two South Korean companies. So I continue to like Micron, ticker MU, top idea still. T-Mobile, Microsoft, I mentioned. Meta, I was disappointed in their quarter, but now the stock has started to rebound after that initial downside reaction. I was waiting. Now I'm a better buy again of Meta. Amazon, I talked about, though I need to hear more about what happened to the CEO of Amazon Web Services. Did he do something inappropriate in the office? Is he going to become the CEO of some other company? But anyway, this was a dream job, and why would he be leaving it? Next, Synopsys, my electronic design automation software company. NVIDIA, I continue to like, even though it's boring that I say that. Broadcom, Duolingo, I mentioned that it was a Meeks buy, did very well for a long time. Expectations got too high, and they disappointed versus those very high expectations. The stock did not hold my 200-day moving average price, so I blew it out. Dell is my cheaper way than Supermicro to play data center servers. Taiwan Semi, as you know, Taiwan Semi, the world's most important, not just semiconductor company, tech company. And also don't forget our buddies in the Netherlands, ASM Lithography, with their extreme ultraviolet technology. Nobody else can do it. And these are two leaders, just not US companies. Alphabet, I've been warming up to. Booking.com has been a great call on this segment for us. Really like the outlook for online travel. And Expedia is a crappy company, and Booking.com is my pick, a very good company. Marvell, ticker symbol MRVL, semiconductor company. Arista Networks, since we last spoke, had a great quarter and the stock really popped just as I thought it would. I'm sticking with it, ANET. And last, Supermicro, SMCI. I still have it on my list, but I only buy it with a very tight $700 buy limit, which is a little bit down from here, but that's okay because this stock is super volatile. It could be there in a nanosecond. So don't push it. $700 buy limit. Let's get to some tech trends to finish up. Back to the macro. As I say, you have to keep watching interest rates. Interest rates tell us if and when inflation will be conquered in this country, because until it is, the Fed cannot lower rates. Right now, it looks from the CME FedWatch tool that the consensus is that the Fed will not start to lower rates until September. And at the beginning of this year, folks thought they were going to lower rates as early as March and lower them 5 to 6 times throughout the year. Now we're going to get 1 or 2 reductions, if that. I would not be surprised if we don't lower rates, even a quarter of a percentage point, until 2025. Right now, the 10-year Treasury note is yielding 4.5%. If it rises to 4.8 and approaches 5%, if it goes in the wrong direction, that could be a bear market trigger for tech stocks. We saw that last October. Tech stocks got hammered when the 10-year Treasury yield eclipsed 5%, even though it was just for a brief period of time. Both the consumer price index and the producer price index come out this week. They're 2 inflation gauges. Watch them carefully. This morning, the PPI came out. The inflation rate between sequentially the last 2 months was up 0.5%. That doesn't sound a lot, but actually showed that inflation is still sticky, still troublesome, because Wall Street was expecting only a 0.3% sequential increase, and they got hotter than that, the 0.5. CPI is probably more important than PPI. PPI is the producer price index. Think of that as business to business, companies buying stuff from each other. And the consumer price index, probably more popular, coming out tomorrow, talks about a basket of goods. What are we paying for a basket of goods in our life between a year ago and today? I mentioned the story of Home Depot. We're starting to see some signs of consumer spending sagging. Home Depot, McDonald's, Target, Starbucks, all have had some troubling results, giving us that indication. Remember, the bad part is it's bad for them. The good part is if the consumer reins in some spending but doesn't go into a deep decline, that could be pretty good, right? Because we'll keep GDP growing. We'll keep the U.S. economy growing because 70% of that is fueled by the consumer, and inflation will come down and interest rates will come down as long as we don't have too much of a knee-jerk reaction from the consumer and we actually drive this country into recession. That would really, really suck. I think these Biden tariffs on the Chinese are significant. Obviously, he's trying to position himself for the election. So announced about tariffs on about $19 billion of Chinese imported goods, including solar panels and EVs. Now, remember, that pales in comparison to the $300 billion tariffed goods from Trump when he was president. But anyway, they're all jumping on the bandwagon, trying to be very antagonistic in the election cycle before the election, November 5th, versus the Chinese. You've heard me say it here before. I want us to cooperate and compete with the Chinese. It's much better for both of us. But unfortunately, it looks like the relationship is getting more and more and more tarnished. The last thing I'd want to mention that I've been hearing a lot about is something called quote unquote patriotic capital. These are the folks in Silicon Valley, publicly traded companies, privately held companies, private equity firms, venture capitalists that are building tech business models around supporting the military, not just here, but with our allies. And of course, one of the biggest tools are cybersecurity data analytics tools. I'm a professor of finance and accounting here at the Citadel in Charleston, South Carolina, and we're bleeding students from our programs because they're going across the quad and they're all about our intelligence and cybersecurity programs. And a lot of them end up working for the Department of Defense. So be wary, be interested, follow very closely the next big trend in tech, patriotic capital. Hey, you guys, it's been great to see you. I will see you next time. Paul Meeks here on Benzinga Tech Tune-Up.